Hi guys, what's up? Welcome to another episode with me, Shashank Oduppa. And in today's episode, I am going to talk about how you can use ETFs to actually create a long-term investment strategy. Now, I know a lot of you guys love investing in mutual funds. Many of you like taking the risk and investing in direct stocks as well. But a lot of people also want to create an ETF basket. So I thought let me quickly make a video for all of you guys where you can create a long-term equity basket, ETF basket, and I will explain the reason why we have chosen all of this as well. So stay tuned. Now, first things first, before we start, by the way, guys, on May 10th, which is this weekend, we are doing a recycling super cycle webinar. So for all the people who are interested in this webinar, I'm putting the link in the comment section. You can join if you want to. Use the coupon code LEARN to get 20% off. This is going to be happening on 10th May, which is a holiday, at 7 p.m. It will be a 1.5 hour webinar. So if you are free, please do join. Now, coming to the actual session, right? Now, look at this. Look at this, right? Number one, why ETFs for long term? Now, compared to mutual funds, ETFs have a very low expense ratio. But the problem is sometimes ETFs are not very liquid. So my job is to find the liquid ETFs that are doing really well. Second, if you take a single ETF, then you automatically get direct exposure to 50 to 100 stocks, sometimes even 500 stocks. As you know, there is Nifty 50 ETF, Nifty 500 ETF, many ETFs. Let me show you some of the interesting ones today. Third, that it is very transparent and very liquid. You can literally withdraw it instantly as compared to, let's say, a mutual fund, which takes T+1, T+2 to actually come back into your account. No fund manager risk because it is an ETF. You don't have active management. You don't have active fees. And the expense ratio is extremely low, sometimes from 0.05 to 0.20, whereas any active fund starts at, I think, 0.7 to 1.5%, right? So that becomes better. You will have a lower portfolio churn because you're not too stressed about the market. In fact, ETF strategy is so beautiful that whenever the market falls, I would ideally like to double down and invest more into the company, into the ETF rather than just staying out, right? And as I said, it's liquid, compounding power kicks in, and 80% of the active funds usually underperform the index over a 10-year period. So if you buy ETFs, there's a very high chance that you can perform at par with the index. And as I said, this is a very passive investing strategy. For your active investing and aggressive investing, you have your stocks, you have your equity, you can become Durandar over there. But if you want to keep like a passive portfolio growing on the side, apart from mutual funds, you can look at this as well. Now, how do I build this entire strategy? There is something called core portfolio and satellite portfolio in the ETF strategy, right? Now, if you look at some examples, for example, this ETF strategy over here, see, if I just take the Nifty 50 ETF, I will do a very good job. If I take Nifty Next 50, I will do even better job. See, because if I put everything into Nifty 50, I might get the long-term compounding average of 12%. But my job is to try and get little more than 12% and not just stick to 12%. So Nifty 50 will give me, if I have a 40% allocation, will give me good, direction in the market for that 12%. But the remaining 60% I will use to get more than Nifty 50, which is alpha over Nifty 50. Nifty Next 50 is basically the next 50 companies of Nifty, which is mostly in the mid cap range. And there's a very fun fact. If you actually go and check, you can do this example today as well. Or you can do this exercise. If you go check in the last 5 years or in the last 10 years, or if you take a longer horizon of 10 or 15 years, okay, even if you take 10 years or 15 years, and if you check which range has beaten the index, is it large cap, mid cap, or small cap? Technically, mid cap has outperformed over a 10 to 15 year time frame. This is because the mid caps are already established companies and they can start growing into large cap companies, and the migration between mid and large is usually easier to do. And then what we will do is we will also keep Nifty mid cap 150 around 20% here. This is again going to give me better alpha and high growth potential. Again, my expense ratio is going to be so low in this, so it's going to be beautiful. I will keep a hedge of 10%, which is your gold ETF. And now comes the last 10%. Now listen to this very carefully. If you analyze India and all the multi-baggers of India, you will notice a very similar trend. Most of the multi-baggers come from the BFSI space, which is your banking financial services. The second type of growth comes from your IT companies. Pharma companies have given tremendous growth. And then you have consumer companies, which is like your Titans and all of that. They have also given tremendous growth. But if I align myself with either IT, pharma, or a bank, then that becomes a very big advantage. Now, if I'm already taking Nifty 50 and Nifty Next 50, then mostly I'm already with banks and I'm mostly already with IT. So I can actually opt for a pharma ETF. And whenever pharma ETF, because it's a cyclical business, whenever it falls, I can actually double down and enter more into it, right? And again, you have to hold this for like 10, 15 years. It is not a, what do you call that, short term play. It is a long term play that you need to look at. Some interesting ones that you can look at from the ETFs, as you can see here. Again, please do your own research before investing. I am a SEBI registered research analyst, so I'm only analyzing from my point of view. But for any investment advice, please contact your RIA, which is a SEBI registered investment advisor. So I'm just showing you some options. These are all the interesting ones in the space, and I'll show you multiple options in different space, right? So if you look at Nifty, Nippon India Nifty Bees, okay, so this is one of the best in the Nifty 50 category, has the lowest expense ratio and highest AUM. Highest AUM means it is also very liquid. So if I show you Nifty Bees over here, as you can see, it is an ETF. It has very low expense ratio and volume of this is also very high. So whenever it falls, usually you will see the volume coming in. And if you look at it from a long-term standpoint, it is pretty liquid. So as you can see here, it is quite liquid. And this is something that you can again look at from a investment kind of a standpoint. If you want to look at it, you can look at it as well, right? Because it is very liquid. Else, you can also look at ICICI Prudential Nifty 50 ETF. As I said, I will show you different options. Again, you talk to your RIA before investing in anything if you ever want to invest, right? Again, as I said, very low expense ratio on this. If you see, the reason why I love low expense ratio is only because when you invest in such companies and the expense ratio is low, you actually get the full benefit of the entire growth rate, right? Whereas if you look at anything else and the expense ratio is not great, then you will have to pay a lot of money to the AMC, which obviously none of us would, pretty much like on that perspective, right? So that is something that I would like to look at. Now coming to the next ones, next Nifty Next 50 is also there. So they have Nippon India and also ICICI Prudential. Next 50 is also there. So if I actually go search here, so Junior Bees is like the next one in the market. Again, it has quite a good low amount of expense ratio. So that again helps you guys as well. And this calculates the next set of growth that you might want to start investing in. Why it has next set of growth? Because if you look at this company as well, it invests in the next 50, which is the Junior Bees. And that again gives you a good rate over here as well to go in. I think the expense ratio of this is approximately 0.17. Again, very low expense ratio. And this tracks the next 50. And again, very liquid. Now for mid cap, you can look at mid 150 Bs. Let me search for that. Mid 150 Bs, as you can see here, right? So this is the mid cap 150 ETF. Okay. So why is this also very interesting? Because this is again from Nippon India ETF mid cap 150, has a very low tracking error. And I think the expense ratio of this is somewhere around 0.21%. So that is the expense ratio of this. And it is the largest mid cap with respect to market cap and volume from the ETF standpoint, right? Again, there is a Motilal mid cap also is there, which is MOM 100. That also you can check out. Same expense ratio 0.20 as well on that front. Now, gold, I think it is very common. I think everyone would opt for a gold bees, Nippon India gold bees that is there. If not, you don't like Nippon India, you can also go for HDFC gold bees, also known as HDFC gold. Okay. Now coming to the other Bs, which is the banking, IT, and if you look at banking and IT, so there is pharma Bs as well. If you look at pharma Bs, let me show you, but very cyclical. These are, please be careful whenever you invest. So pharma Bs is there. As you can see, if I open pharma Bs and show you, right now pharmaceutical industry is on the verge of a breakout, but it has not broken out yet. So pharma Bs is something that, definitely you should keep a track on. But it is very cyclical and the expense ratio of this is also 0.21. There is also banking Bs. You can also check out banking Bs because these are all ETF. Nippon India has a very good chunk of money coming from passive investing. And this is something that they actually do very well with. And if you see, this is the banking Bs. But if you have already taken Nifty 50 and Nifty Next 150, then you have pretty much a lot of banks into it, already blended into it. So I would not, go too deep into that as well. But this is something that you can definitely try and look at. Now, why is this important? Because if you actually map it out from an SIP calculator perspective, main thing is to understand how much it is ETF versus mutual fund. If you do that math, you will see that an ETF can give you a net return of 12.9 over a period of time, only because if I take an average return of 13%, and ETF expense ratio is 0.1, an active mutual fund can go up to 1.5, which is the highest side I've taken, right? Even if I don't take 1.5, even if I take 0.7, you still compound 0.5% every 0.5% every year, which over a period of 10 years or 15 years adds up a lot. And pretty much you get the same exposure, right? And over a 10-year period, very few funds have been able to beat the index. Now, every month, if you keep changing, you will have a problem. Now, another advantage of investing in an index fund, apart from, I mean, investing in an index as well, is tomorrow, if you want margin, you can even pledge the ETFs to get margin. If you want money instantly, you can sell that and get instantly. If you want loan against security, you can do that as well. You can actually sell the ETFs and get loan against security. You'll have a lower haircut allocation over there as well, right? And if you look at an annual return of 13%, I'm assuming that India will have some kind of growth rate without any step up. Then over a period of time, if you look at a monthly SIP of 1,000, over a period of 30 years, it'll be 44 lakhs. And if you look at a monthly SIP of 1 lakh, it should compound to around 44 lakhs, 44 crores over 30 years. Again, in the next 30 years, obviously inflation will be there, so it is not going to be very attractive. And as I said, this is a passive investment strategy. For active investment, I think you already have Durandar style investing. And if you really want to do passive investing, you should always do step up. What do I mean by step up? One is definitely increase your allocation every year by, let's say, 5% increase. Also, you can increase that retirement corpus by a lot. And what I usually do with ETFs, why it is very beneficial, is when the market falls. Like now, the market has fallen so much. When the market falls, that is when I would like to double down and put more money into the ETFs. Then I can do loan against securities, pledge it for margin and do F&O. I can do whatever I want, right? But again, that is up to you. But it is a very good passive strategy. Now, how do I do rebalancing? Now, a lot of people have the buy and forget strategy, but I like to check the strategy once in every year. Let me go and check what is going on. And here I'll have a rebalance rule. Let's say I bought the IT Pharma Bs and pharma went up a lot that year. Let's say pharma went up 20-25%. Now that becomes a very big portion of my entire basket. So I would want to keep the deviation less than 5%. Let's say today pharma went up 10%, the entire ETF went up 10%. I would be very careful. In fact, I would take some money out of that pharma index and put it into something that has fallen down in that year. Maybe Nifty 50 has fallen down, I will go put there, right? So I would do that. Direct fresh SIP, you start doing into the underweight ETFs. Avoid selling these ETFs, keep it as long as possible, because if you sell it, you have to pay capital gains tax of 10%, 12.5%, or even 20%. If you want capital, you can always pledge it. If you want capital, you can do LAS, do what the rich people do, which is they never sell their equity, let the equity compound, and they do loan against securities or whatever. And that is something that I would do it. And don't check it daily. These are ETFs. This gives you shanti, peace of mind. Paisa aaya, dalo account mein, and buy some more ETFs and hold for a long period of time. Now, I know people who are invested in mutual funds might have a problem with this, but this is again an alternative option that I was showing you of all the different ETFs that are there. Now, yes, there are some interesting ETFs. I know some people would want to go into silver, all of that. I would say don't get into silver ETF. Please be a little careful on entering the silver ETF. I would not do that, honestly. But yes, anything else, I think you can look at it. There is a nifty, I mean, if you want to play a little more risky, there is another one, but I don't know which ETF. I don't know if there's an ETF there, but there is a momentum fund for it. I mean, if you guys know, yeah, I think this is the one. So momentum, I don't know if this is an ETF. Yes, this is an ETF. So there is momentum 50. Let me just check this. Momentum 50 ETF. Yes, so Momentum 50 is basically Motilal Oswal Nifty 500 Momentum 50 ETF. So I like putting some kind of small allocation into Momentum ETFs only because, you know, sometimes the alpha might come. Sometimes it can come and it can be well. So I would like to put some amount, not a very big amount, but maybe 5% into momentum based ETFs, right? So that can actually give you some kind of advantage if you do that. But then rest, I think I will leave it up to you. What is this? This is Mon 30 ETF. Yeah, this is something I would prefer. This is basically your ICICI Prudential Nifty 200 Momentum 30 ETF. Because this is something that, you know, would be better from a long-term standpoint, because I've seen this grow over the past. In a bull run, this gives a very good advantageous growth. In a bear run, it obviously takes that level of drawdown because it's momentum. So as all momentum funds, they take drawdown as well. So that is how I look at it. But again, this is a long-term investing strategy, not a short-term investing strategy. So I would prefer you focus on that. Again, I would like to invite you to the webinar that we're doing this weekend. If you have 1.5 hours, come and learn as much as you can. And again, if you have any doubts, any questions, please do let me know. And please subscribe to the page if you're watching me for the first time. Thank you. This is me, Shashank Godapa, signing off, guys. Take care. See you. Bye-bye.